Good evening. Tonight we're focusing on a story that touches nearly every part of our lives. The price of oil. Oil powers our industries, heats our homes, and fuels the transportation that connects the world. Because it's so essential, its price is watched closely by world leaders, businesses, and families. A change in oil prices can quickly impact our daily expenses and the global economy. These prices react to real-world events, political decisions, conflicts, and even a single headline can send prices soaring or tumbling. When global tensions rise, oil markets become volatile. Recent geopolitical events have put the world's oil supply under scrutiny, shaking up markets everywhere. From the Caribbean to Eastern Europe and the Middle East, the stability of oil markets is being tested. Tonight, we'll break down these events and explain why they matter to you. We'll look at the situations causing this volatility and how key countries' actions are fueling uncertainty. By examining each piece, we'll reveal the bigger picture behind the numbers. This isn't just about economics, it's about global power, conflict, and the resource that fuels our world. Let's unpack the forces driving oil prices today. Stay with us. As the holiday season approached, oil markets reminded us of their volatility. On December 23, 2025, oil prices dipped slightly in Asia after a sharp surge that had traders on edge. The earlier spike was driven by fears of supply disruptions from global tensions. Brent crude fell to $61.98 a barrel, and West Texas Intermediate settled at $57 to $90. These small decreases followed intense upward pressure as the market paused after a wave of troubling international developments. With year-end trading volumes low, price swings can be exaggerated. Despite the dip, 2025 has seen significant overall losses for oil prices, driven by concerns about a slowing global economy and potential oversupply. The recent surge was a sharp reversal. The market is caught between long-term worries about weak demand and immediate fears of supply shocks from geopolitical conflicts. The slight dip signals a temporary calm, but the underlying tensions remain. The world is watching for the next move. One major source of market anxiety is the escalating tension between the US and Venezuela. The US is moving to seize a third oil tanker linked to Venezuela, part of a broader strategy to blockade sanctioned oil shipments. Venezuela, with the world's largest proven oil reserves, is a key player in global energy. Disrupting its exports can send shockwaves through the market. The US aims to pressure Venezuela's government by targeting its oil exports, risking a tighter global supply. President Trump has stated the US will keep seized oil and tankers, possibly selling the oil or adding it to the Strategic Petroleum Reserve. This raises the stakes and increases the risk of confrontation in the Caribbean. China, a major buyer of Venezuelan oil, and other countries are watching closely. Even the threat of seizures can scare off shippers and insurers, making Venezuelan exports harder and costlier. This is classic geopolitics, creating a risk premium in oil prices. Traders are pricing in not just current supply and demand, but the risk of future shocks. The US-Venezuela standoff is a key reason for market jitters. The world is on edge. The U.S. blockade of Venezuelan oil tankers is a direct form of economic pressure with immediate market consequences. By using its navy to enforce sanctions, the U.S. aims to cut off Venezuela's main revenue source. Seizing tankers is risky and could be seen as aggression by Venezuela and its customers. The targeting of a third tanker shows the U.S. is serious, sending a warning to the global shipping industry. Any company moving Venezuelan oil now faces the risk of losing its vessel and cargo. Removing a major producer from the market forces others to try to fill the gap, but that takes time. Even the potential for reduced supply makes oil more valuable. The blockade injects uncertainty. No one knows how long it will last, or how Venezuela might respond. Could this spark a wider conflict? The unknowns fuel market anxiety. Investors often react by buying oil futures as a hedge. The blockade isn't just about today's barrels, it's about tomorrow's volatility. The world is bracing for more instability. Meanwhile, the Russia-Ukraine war is adding more pressure to global oil markets. Ukraine has launched targeted attacks on Russian oil infrastructure, terminals, pipelines, and vessels. These strikes aim to disrupt Russia's ability to fund its war and export oil. Russia is the world's second-largest oil producer, and even with sanctions, much of its oil still reaches global markets. Ukrainian attacks threaten to cut this flow further. Damaged infrastructure can take weeks or months to repair, reducing exports and tightening supply. Each new attack makes a quick resolution less likely, increasing the risk premium for oil. The conflict is now directly impacting the infrastructure behind a huge share of the world's energy. This escalation adds to global instability. Oil prices remain elevated as the world watches Eastern Europe. The market is on high alert. Attacks on oil infrastructure reveal just how fragile the global supply chain is. Oil's journey from well to gas tank involves rigs, pipelines, terminals, refineries, and tankers, each a potential point of failure. Ukrainian strikes on Russian facilities show how hitting a single pipeline or port can back up the entire system. Damaged terminals or loading docks can halt exports, even if wells and pipelines are still working. Repairs are complex and time-consuming. Pipelines, often in remote areas, are prime targets and hard to fix. Attacks on vessels make shippers wary, driving up insurance and transport costs. A regional conflict can quickly become a global supply crisis. By targeting each link in the chain, the flow of oil is choked off. The world feels the squeeze. The Middle East remains a perennial source of oil market anxiety. Tensions are rising again between Israel and Iran, two regional powers with a long history of conflict. Recent Iranian missile tests have heightened fears of escalation. The Middle East is home to the world's most important oil choke point, the Strait of Hormuz. If conflict erupts, Iran could disrupt shipping through the strait, threatening a huge share of global oil supply. Even the threat of such action sends panic through markets. Traders add a risk premium to oil prices, paying not just for oil, but for insurance against Middle East turmoil. Rising rhetoric and military posturing create uncertainty. The market prices in worst-case scenarios. The fragile peace of the Middle East always matters for oil. Let's connect the dots. The US is pressuring Venezuela, Ukraine is attacking Russian oil infrastructure, and tensions are rising in the Middle East. These aren't isolated stories, they're all threats to global oil supply. When traders sense future supply is at risk, they bid up prices to secure oil now. The US blockade, Ukrainian attacks, and Middle East tensions all point to tighter supply. One of these events alone would make markets nervous. All three together create real anxiety. The recent price dip suggests some panic has eased, but the risks remain. This shows how interconnected our world is. A decision in Washington, a strike in Ukraine, or a missile test in Iran can affect energy prices everywhere. Oil prices act as a global barometer, measuring geopolitical pressure. When pressure rises in multiple places, prices go up. Understanding these links helps explain why your energy bills change. The market is always watching for the next shock. Global events move the price of oil, and your wallet. Why does all this matter to you? Because oil prices shape your daily life. When crude oil rises, gasoline prices follow, making it more expensive to drive, commute, or run errands. Higher fuel costs ripple through the economy, raising prices for goods transported by truck, train, ship, or plane. This can lead to inflation, making everything from food to electronics more expensive. Oil prices also signal economic health. High prices can slow growth, acting like a tax on everyone. That's why governments and central banks watch oil so closely. The tensions in Venezuela, Ukraine, and the Middle East aren't just headlines, they affect your wallet. Staying informed helps you understand the forces shaping your economy. In our connected world, global events have local consequences. Oil prices are everyone's business.